All right, our next exercise is going to be exercise 17-19, and that's accounting for uncertain tax positions. And to be honest with you, this is a very controversial provision in the GAAP regulations because companies are saying that when I have to disclose an uncertain tax position, it's basically giving a roadmap to the IRS as where to audit me. And so there's some very interesting consequences to that, but nevertheless, we need to learn this for our purposes. And so we're going to do this. So if we look at 17-19, we've got the Lewis Eagle Corporation concluded that it was able to exclude $2,500,000 income from its current tax position. Income before the exclusion was $6 million. There are no book tax differences. This income is subject to a 30% tax rate. Based on its technical merits, Lewis Eagle determined that it is more likely than not that the exclusion would be sustained upon examination by auditors. The possible outcomes and the related probabilities are as follows. And we see a range of probabilities that they would allow the full $2,500,000 was 10%, that they would allow $2 million of the $2,500,000 was 20%, that they would allow $1,500,000 was 25%, that they would allow $1 million of that would be 35%, and that they would only allow $880,000 would be 10%. And so the way we do this, we're going to go ahead and create a chart here with the various amounts, $2,500,000 and 10%, $2 million, 20%, $1,500,000, and that will be 25%, $1 million, and that is 35%, and then finally 880,000 was 10%. Okay, so what we're going to do is we're going to make a cumulative total of this, and we go down and we say, so the cumulative total at this level is 10%, but the cumulative total here is 30%, the 10 plus the 20, and the cumulative total here is 55%, and on down the line, 90% and 10%. Now, where we go is we go down until we are over 50%, the more likely than not, which is this amount right here. And that is what we will put on our books for uncertain tax position. It will be the difference between the $2,500,000 and the $1,500,000. So we take the $6 million prior to the exclusion of income, and this will be for GAAP, and this will be for tax, and we will take into account that that for GAAP we're going to exclude the $1,500,000, this level right here. For taxes, we're going to tell the IRS we're excluding all $2,500,000 of that. And so when we add that up, that's $4,500,000. This will be $3,500,000. And we now multiply that times the tax rate, which is 30%. And 4,500,000 times 0.3 is 1,300,000. $350,000, and $3,500,000 times 0.3 is $1,050,000. All right, so now we're going to have our book entries. So our tax expense will be this number right here, the GAAP amount, $1,350,000. Then we're going to have our taxes payable, and that's going to be this amount right here, the $1,050,000. Wouldn't you love to write that check to the IRS? And so the difference here, the $300,000 difference, will be uncertain tax provision, uncertain tax position. Liability for $300,000. And that is how we disclose an uncertain tax provision and how we calculate it. And that concludes exercise 17-19.